Hello everyone, welcome to lecture 4 of module 1 on financial statement analysis. In lecture 4, we will discuss about the different financial statements like income statement and its components, balance sheet and its various components. To start with, the financial statements. Financial statement is the end product of the accounting process considering all the activities executed by a business in a fixed time period or in a financial year to find out the financial domain of the business in different categories. Financial statements are crucial not only for the business but also for the different stakeholders as it provides information regarding the financial performance, financial position of a business. This information is used by the different stakeholders in different domains to take the decision regarding investment, forecasting, and analysis of a business performance. The financial statements are required to track the performance of a business in a given period of time, which will help in making the strategic decisions that how a business will proceed in the future, and it will help in financial planning also. Financial statements are prepared as per the regulatory requirements and the different accounting standard issued by any government in the country. Financial statements are the direct means of communication regarding the financial position, profitability, its cash flows of any business in a given span of time, usually a year. So, financial statements, they are the true mirror image of any company's performance in a financial year or in a given span of time. These statements play a very vital role in creating an image in the eyes of the different stakeholders. Stakeholders are directly affected by the information provided in the financial statements. Whether they invest, whether they continue their relationship with the business or not, it directly depends upon the financial position of a business. Financial statements provide an insight into the performance, what business is doing, what are its earning, where it is lacking, and how it is going to make itself best, and the appropriate use of the different resources available. It also includes the operations, what the business is doing, what the business is not doing, and the cash flow of a business, that is the record of inflows and outflows of cash. The financial statements are divided into three categories. Number one, income statement, that summarizes the revenue items relating to the generation of revenue and the expenses. Then the cash flow, that deals only with the inflow and the outflow of the cash flow in a given period of time. And the balance sheet, the topmost important and prioritized financial statement used by the different users to take the decision. It reflects the financial position of a business on a given period of time. It is a summation of the assets, liabilities, and the equity of any organization. To start with the financial statement, we first deal with the income statement. Income statement, also known as profit and loss statement, which summarizes all the revenue items, both operating and non-operating in nature, related to revenue as well as the expenses. And in addition to that, we also consider taxes to ascertain the profit over a specific span of time. The major components of income statement are sales, cost of goods sold, operating expenses, operating income, non-operating expenses, non-operating incomes, and the end result is the net profit. To start with, the cost of goods sold. The cost of goods sold includes the cost of the material, which is the direct material used to create the product, and then labor, which is the wages and salaries paid to the workers directly involved in the production process, and the manufacturing overheads directly associated with the production or procurement. These manufacturing overheads include utilities, rent for the production facilities, depreciation of equipment, freight inwards, carriage inwards, etc. And the cost of goods sold is calculated using the formula opening inventory plus purchases made during the year and deducting from the same the closing inventory. After it is considered the cost of goods sold, when it is deducted from the sales, we reach the figure of gross profit. The gross profit is used by the stakeholders to measure the operating efficiency of a company or the conversion of the material into the sales by using different ratios, and gross profit is used by the company to find out the gross profit margin and to plan accordingly its future activities. Then the next is operating expenses. Operating expenses are the cost a business incurred during its normal operations to generate a revenue. They are indirect costs incurred by the business to ensure the day-to-day activities of any entity, but it does not include cost of goods sold and the capital expenditure. Operating expenses are very crucial to understand the profitability of a concern. Different types of operating expenses include rent and utilities like rent paid for the office, electricity, interest, water, etc. Salaries and wages paid as a compensation to the employees of an organization, marketing and advertisement, that is the promotional activities, ads, branding cost, etc., office supplies and equipments, software subscriptions, stationery, computer and other related activities, insurance, legal and professional fees, depreciation and amortization means allocation of all type of cost of tangible and intangible assets over a span of time. And research and development, which is the cost associated directly with the innovations and the product development to ensure the continuity and the reputation creation for an organization. And next is the travel and entertainment for client meetings, meals, and the business travel. Operating expenses are very important to assess the profitability of the concern as they directly affect the profit. If they are incurred beyond a limit, then the cost control is must to be undertaken by the organization so that the fluctuation in the profit can be controlled. It also impacts the valuation of business health. Second is operating income. Operating income is EBIT, that is the earning before interest and taxes. It is the company's profit from its core business operations excluding interest and taxes. It will be used to measure the efficiency of the business, and it also used for the comparison of the company's performance across its rivals and industries. Then we have next head of non-operating expenses. Non-operating expenses are actually the cost any business incur that are not related to the core operations of a business. They are typically come from the activities outside of the business entity and day-to-day functions of a business, such as interest payment, losses on the sale of assets, legal settlements, foreign exchange losses due to the fluctuation in the currency rates, settlements, write-offs and impairments mean the losses from the assets devaluation due to inventory obsolescence or goodwill impairment. Non-operating expenses also help to analyze the financial position of a business, and it have a direct impact on the net income of the business. If non-operating expenses are high, they will reduce the overall profitability of a concern, which is not a good sign. to attract the outsiders as an investor or the potential investors in future, company has to play an important role to control all these expenses. Sometimes these expenses are recurring in nature, like interest expenses, but more or less it could also be falls in the category of one-time expenses if it arises in the term of legal settlements. Then the next head is non-operating incomes. It refers to the revenue or the gains that a company earns from the activities outside the purview of its core business activities or operations. These earnings are typically irregular, or we can say incidental in terms, because they are not related to the primary product or services of a company at all. Different types of non-operating income includes the income in the terms of interest which a company can earn from the savings or their investment in the outsiders like bonds, loans. Then company have another source of non-operating income is in the term of dividend income, that is a profit from the investment in the stock of other companies. Then profit from the sale of assets such as land, building or equipments. There are foreign exchange gains too, which may occur not frequently but incidentally in certain cases due to the currency fluctuations. Rental income, earnings from leasing out the unused space or the property by the company to the outsiders. It is again not the core business of an organization. Insurance payouts. These are the compensation received by the company in the form of insurance claims. Then the legal settlements received due to the cases against the outsiders of the business. After dealing with all these, we will reach the figure of net profit. Net profit is the net income of the business. It is the total amount that a business earns after deducting all revenue nature expenses, whether they are operating or non-operating, and the operating and non-operating incomes and taxes and interest. It represents the actual profit available to the owner of the business, or in other terms the shareholders of the business. The net profit is a measure used to know the overall profitability of a concern. It directly indicates the financial stability of any business, and it affects the shareholders' earning because it leads to the payment of dividend, and hence it will affect the stock prices of any organization. So the outsiders, the shareholders, who are the investors at present and the potential investors, to decide their investment in such company largely depend upon the income statement and the information provided in the terms of net profit. This is the outline of the income statement, in which, after considering the cost of goods sold from the sales, we reach the figure of gross profit. Gross profit is also help us to know the performance of a business. Then out of that gross profit, operating expenses, sales and administration expenses, research and development expenses are deducted to reach the figure of operating income, which is also known as EBIT, earning before interest and taxes. Out of it, other incomes, non-operating incomes and non-operating expenses are taken with. Then we are left with earning before taxes. And out of this, once the taxes are deducted, we reach the figure of net income, which is known as the net profit or loss to an organization. All organizations work with the objective to maximize its profit in terms of the resultant of the income statement. Moving ahead with another financial statement which plays a crucial role for the company's financial position, performance, and reputation, creditworthiness, and trustworthiness in the eyes of internal and external users is the balance sheet. Balance sheet is the financial statement that provides a snapshot of company's financial position on a specific time period after considering all assets and liabilities. The different components of the balance sheet are current assets, non-current assets, current liabilities, non-current liabilities, and equity. When we talk about assets, we divide the assets into two parts. One is the current assets and another is the non-current assets. And liabilities are current liabilities, non-current liabilities, and the last part of the balance sheet is equity. Current assets and the current liabilities are the key components of a balance sheet representing the short-term financial resources and obligations of a company. Current assets are also termed as short-term assets or the resources a company expects to be converted into cash or cash equivalents within a time span of 1 year. It includes cash and cash equivalents, means money in hand and the bank balance, account receivables, money owned by the customer from sales made on the credit basis. Inventory includes raw material, work in progress, finished goods which are ready to be sold in the open market. Then marketable securities, these are the short-term investments of the company which include stocks and bonds. And the last is prepaid expenses, which are the advance payment made by the company for different services such as insurance and rent. Now, on the liability, we have the current liabilities. Current liabilities are the debts and the obligations that a company must settle down within a span of 1 year. Common types of current liabilities are account payable, mean money owed to the suppliers of the organization. Short-term debts mean loans and credit lines due within a span of 1 year. Accrued expenses, expenses incurred but not yet paid, means the salaries and the taxes. Unearned revenues, payment received for the services and products not yet delivered by the company. And then we have tax payable, mean the corporate tax liability of the company to be paid to the government. These two things, current assets and current liabilities, are very important for the company to be disclosed in the balance sheet because they are used to as a measure for the liquidity position of an organization to pay off its short-term liabilities when and whenever they accrue, or they are the obligations to be met within a given span of time. It helps to calculate the working capital also. Working capital is none but the difference between the current assets and the current liabilities. Working capital, in other terms, is the fund required by any organization to meet its day-to-day expenses. It is also used as an indicator of the financial health of the company, because if it is there that the company is having more current assets in comparison to its current liabilities, it indicates the strong liquidity of the organization and is a positive signal that the creditors or the other current liabilities will be paid on time without any failure. It will also help the companies to have a proper creditworthiness and trustfulness in the eyes of its short-term liabilities. Then we have another term of non-current assets and non-current liabilities in the balance sheet. Non-current assets and non-current liabilities are the long-term financial components of company's balance sheet. They represent resources and the obligations which are payable by the organization beyond a span of 1 year. Non-current assets are the resources owned by the company for its creating the value or converting the cash or using efficiently the different things available in the terms of assets. Common type of non-current assets in any business can be property, plant and equipment, which includes machinery, land, building. Long-term investments include stock, bonds, investments held by the company for a span more than a year. Intangible assets like patents, trademarks, copyrights, goodwill. Sometimes it also includes deferred tax assets, which means future tax benefits available to the company from deductible temporary differences. Then we have non-current liabilities. Non-current liabilities are the liabilities which are paid after a span of 1 year, and it includes long-term debts, pension liabilities, which is payable by the company to the outsiders of the business. Last component of the balance sheet is equity. As the balance sheet is prepared on the basis of accounting equation which says that all the assets of a business should be equal to the liabilities plus equity. Equity is nothing but the shareholders' equity or owner's equity in other terms that represents the value which is left in the company after meeting all its liabilities out of the assets. It reflects owner's claim on the company's assets. The components of equity include the share capital. Share capital is further divided into two parts. One is the common stock, which represent the ownership and the voting rights, or in other terms we call it equity shares or equity share capital. Then the second is the preferred stock. Preferred stock is a hybrid between debt and equity, but it carries a fixed rate of dividend when dealt in the financial statements. Second part of the equity is retained earnings, means the profit that is reinvested in the business instead of being distributed among the shareholders in the term of dividend. Third is additional paid-in capital, which is the extra amount investors paid over the par value of the stock. Par value is nothing but the face value of the shares. If the stockholders of the investors or the shareholders pay anything extra, it will fall under the category of additional paid-in capital. We can also include in it the treasury stock, is the shares that are repurchased by any company for reducing the total equity of a company itself. Then other reserves can be included like foreign currency adjustments, revaluation gains, etc. So the total of the liabilities and equity, current liabilities and non-current liabilities should be equal to the current assets, non-current assets, to give it a snapshot of the financial position of a company at a given date. The equity is very important because it indicates the ownership value, means higher the equity value reflects the more value for the owners of any organization. Used in financial ratios, equity plays a crucial role in the calculation of return on equity, termed as ROE. This ROE, if it is higher, it will always attract the outsiders to make the investment in the company. Then it also determines the dividend payment, that the company pays dividend for equity shareholders, and dividend payout ratio will also calculated with the help of the equity. Whatever we have discussed today, it has another part is in the term of cash flow. Cash flow deals with the inflow and the outflow of the cash flow. All these statements are important from the point of view of the different users of the financial information, which are already discussed in this module. They are internal and external. They are largely affected by the information provided, these statements provided by the income statement of a company and the balance sheet of a company. If company plays any negative role in showing the overvaluation or the undervaluation of the expenses just to make lucrative figure of profit to attract the investors, is not acceptable because of the various accounting standards and other rules and regulations applicable in the country. Fabrication is not acceptable in the terms of financial statements. Thank you so much for your kind attention.